Hello, one and all present here. This is Amit Kumar Singh, and welcome to the third class on the discussion of this International Financial Management paper, which happened on October 2020. So, till now, I have done numericals for section A and section B. In section B, we have done till swap question, interest rate swap question. I really suggest you people to study the difference between currency swap and interest rate swap. Although in Bangalore City they don't ask questions based upon currency swap, but it would really great if you have a knowledge about what is currency swap and how currency swap is different from interest rate swap. Okay, guys, so let's do this question number 11. So there's a company called Darshini Limited. They have imported 5,000 bottles of shampoo at a landed cost in Mumbai of $20 per each bottle. The company has a choice for paying for the good immediately or in 3 month time they can pay. It has a clean overdraft limit where 14% interest is charged. Okay, so because you know that this company has imported shampoo bottle, so they need to pay money. So one bottle is 20, so 5,000 bottle. 1 minute. So one bottle is of $20. So 5,000 bottle will be how much? 10 and then 40. So 10 and 40 means 1 lakh dollar. Okay, so the company has a choice that they can pay the money right now. If because if they want to pay money right now, if like they're they're mentioning about overdraft limit where the rate of interest is 14% per annum. So here what I can assume that the money what they'll pay, if they'll try to pay right now, immediately if they'll try to pay the money for the import what they have done, for that they'll borrow money from the overdraft account, and for that 14% interest they have to pay. Okay, so three month, so 14% per annum. So if you calculate for 3 month, so that would be around 3.5%. So 14% per month per annum for 3 month. So that is 14 divided by 4. So 7 by 2 means 3.5% for 90 days. So if they want, they can borrow the money at 3.5% for 90 days, and then they can pay the money. Okay, so that they can do, they can pay in 3 month time. Probably they can pay in 3 month time, and for that the rate of interest is 10%. Okay, so the rate of interest is given for in that scenario, that is 10%. I assume that would be 10% per annum, and they can cover the risk. Then, if they want, because they know that probably after 3 month time, they need to pay around $1 lakh. So what they can do, they can either follow money market hedge or they can follow forward hedge to cover their risk. Then the spot rate and 3 month swap rate is given to you. So let's try to solve this problem. So in this question, first I'll do that second case, that if they'll settle now at the current spot rate and pay the interest on the draft for the 3 month and pay the interest on the draft for 3 months. So first I'll do the second case. Okay, first let me take the screenshot. So you can see this problem. Okay, so you can see the number is 5,000 bottle, 5,000 number is 5,000 bottle, and the selling price landed was Mumbai. So the selling price of like for the Shin Limited is a cost only. So it was not the selling price. They are buying the importer. So for the cost per bottle is $20. So the total invoice, if you see total invoice, the total invoice is 5,000 into 20. Okay, so 5 twos are 10, and after that if I count the 0, 3 plus 1, 4, 0. So 1, 2, 3, 4. So $1 lakh is the total commitment for the company to pay. Okay, so imagine if they settle now, and so imagine if they settle now at the current spot rate. Okay, so the current spot rate is $1 is equal to 70.25 slash 70.55 rupees. This is the current spot rate. So if they want to pay right now, so how much they need to pay? So so how much they will pay? They will pay in rupees how much? So the total invoice in rupees will be how much? Total invoice in rupees. This is 1 lakh. So 1 lakh means 10 to the power 5 into 70.55. This is the total amount in rupees. Okay, this is the total amount in rupees they need to pay. But here I'm doing the second case. Here the thing what we are assuming that they don't have that fund right now. So what they'll do, they'll borrow money from the bank, from the overdraft account, where the bank will charge 14% interest. Okay, so 14% interest per annum. So 14% interest. So rate of borrowing. So the rate of borrowing, that is equal to 14% interest per annum. That is the rate of borrowing. That is the rate of borrowing. So for 90 days, so this is the rate of borrowing, 14% per annum. So the rate of borrowing for 3 months, the rate of borrowing for 3 months, that is 14%. 3 months, that is 3 divided by 12. So this is 14% into 1 by 4. So that is equal to 3.5%. This is the rate of borrowing for the 3 month. That is 3.5%. That is the rate of borrowing for the 3 month. That is 3.5%. So the amount what they need to pay back, the amount they need to pay back, pay back to the bank after 3 month, after 3 month, how much the amount they need to pay back. So the money what they're going, that is 70.55 into 10 to the power 5 into 3.5% is the interest. So 1 plus 0.5%. So everyone understand the concept of amount. Amount is equal to principal plus interest. This is 7055, then triple zero into 1.035. You can calculate this. So you can calculate this 7055 into 1.035. That is how much? 73017301925. So 73 lakh 1925. This is the amount what they need to pay back after 3 months. Okay. So this is the amount what they need to pay back after 3 months. Okay. So this, if they go with the second option. Now I'll think about the first option. Where they'll try to do hedging. Okay. I'll think about the first option where they'll try to do the hedging. Option one. So you know that total invoice is $1 lakh. Total invoice is of $1 lakh, to be payable, in 90 days. To be payable in 90 days. So what they can do, so the so here, so the amount, so they need to pay $1 lakh, where the rate of interest is 10%. So if I talk about money market hedging, if I talk about money market hedging, in this case, if I talk about money market hedging, then the amount need to invest in US, need to invest in US, the amount what you need to invest in the US, if the rate of interest is 10%, that is 1 lakh divide by 1 plus 10% divide by 4, because 10% that is for per annum, so 10% is per annum, so for 3 months that would be 2.5%. So how much they need to invest in US for 3 month, so that it become $1 lakh. Okay, so that amount is equal to this much, that is 1 lakh divided by 1.025. Okay, so this come around how much? 1 lakh divided by 1.025. 1 lakh 1 2 3 4 5 divided by 1.025, that is 97561. 97561, that is 97561 dollar. This much they need to invest in US for 3 months, so that it become $1 lakh. 97,561 dollar. This much they need to invest in US. Okay, so 10% per annum. So that is the rate of interest given in the problem. So pay in 3 month time with 10% interest and cover risk forward for 3 months. Okay, so now if they need this much to be invested in US, so this much dollar how they will get. So the firm need 97,000. So the firm need 97,561 dollar uh, for investment in US. So, so what is the so how much they need to borrow in India? So the amount what they need to borrow in India, the amount what they need to borrow in India, so that it become 97,561 dollar. So for that you need the current spot rate. So the current spot rate, you can see the current spot rate, that is $1 is equal to 70.25, 70.55, 70.25, 70.55, 70.25 slash 70.55 rupees. So to get 97,000, so 97,561 dollar will be equal to how much rupees? So how much they need to borrow? 97,561 into 70.55. You can do this calculation. 97,561. This into 70.55, 70.55, 68,82,926, 68,82,926.83. So, so this much rupees they need to borrow. So if they'll borrow this much rupee, you know that rate of interest in India is 14%. That is given. So I'm assuming that is the rate of interest in India. So what is the amount they need to pay back to the Indian bank? So the amount need to pay back to Indian bank. So that would be 8,82,926.83. On this is the money what they need to borrow, and rate of interest in India is 14% per annum. So 1 plus 14% divided by 4, you can do that calculation. So that is 68,82,926.83 into 1.035. So the rate of interest. So 14 divided by 4, 3.5%. 71 lakh 23,000. So that is 71 lakh 23,000 829.27. So this much they need to borrow. Sorry, this much they need to pay. This much would be the commitment. 71 lakh 23,829. Okay, and here that is 73 lakh 1,925. 73 lakh 1,000. So 73 lakh 1,000 is lesser than this. You can do this now. This is no hedging. This is the case of no hedging. This is the case of no hedging. This is the case of no hedging. While this is the case of money market hedging. We call this as a money market hedging. This is the case of money market hedging. Now I'll talk about forward hedging. Now, now I'll talk about forward hedging. Now I'll talk about forward hedging. So in the forward hedging, I need the forward rate. So the rate is spot rate is so the spot rate is so the spot rate is 70.25 slash 70.55 rupee per dollar, and 3 month forward rate is 35.25. 35 minus, if you subtract 35, so 70.25 minus 35, I think that was 69.9. 70.35, this is 0, this is 9, 69.9, 69.90, and then this is 35, then 25, so then 25, so 70.55, then 25, so this is 70.30 rupee per dollar. So you understood this. Now I believe, uh, see, if you see, if you understand the concern of importer, if you understand the concern of importer, if you understand the concern of importer, that importer has to pay, importer has to pay in US dollar, importer has to pay in US dollar, and if US dollar is 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 a discount, if US dollar forward rate, if US dollar forward rate, as you can see, is a discount, is at discount, then because he had the concern that it will appreciate, no, because why he will take the why he will take the why he will take the uh, why he will take the forward contract. 1 minute. So the importer has to pay in US dollar. So if US dollar forward rate is a discount, so I hope you're understanding the logic, that why he will go for forward contract, because he has to pay in US dollar. And if used, because so if you go to derivative market, so what he'll take long position on forward contract or future contract, or in options. If you want to take position in option, then probably he can take long call or short put. Okay, so here, if you see the concern for the importer has to pay in US dollar, and if US dollar forward rate is a discount, and if US dollar forward rate is a discount, then covered position, then according to me, covered position is not ideal. Is not ideal, because if you are very sure about that the dollar is not going to appreciate, if you are sure that your rupee going to appreciate, then no need of taking covered position. Or even then if you take covered position, so even then even then 3 month forward rate, even then the 3 month forward rate is $1 is equal to 69.90 slash 70.30 rupees. Okay, so 70.30 rupees. Okay, so if you want to take covered position, so 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 the exercise price, so the exercise, not the price, rate. So the exercise rate of rupee dollar contract will be how much? That would be 70.3 rupees. Okay, so total is how much? 1 lakh dollar, no? So the total value of long forward contract would be how much? That would be at 70.3 you will take, and that is 1 lakh dollar. 1, 2, 3, 4, 5. 1 lakh dollar. So if you convert into rupees, that is 73, then 40. Okay, fine. So you got this. So now we need to suggest which is the ideal situation. So which is the ideal situation? So I did all forms of calculation. So here either he can do no hedging. So if you do no hedging, then what is the cost? Then what is the cost? If you do money market hedging, then what is the cost? And then if you do forward market hedging, if you do forward market hedging, then what is the cost? If you do no hedging, if you do no hedging, no hedging, no hedging, no, this is no hedging. So the cost is 73 lakh. 1 minute, let me write it somewhere. 73 lakh, 73 lakh 1,925. Okay. Then money market hedging, that is 71 lakh 23,829.27. Okay, and forward market hedging if he's doing, so forward market hedging if he's doing, then it costing 70 lakh 30,000. Okay, situation is there. So no hedging cost is 73 lakh 1,925. Money market hedging if you do, then the cost is 71 lakh 23,829.27. And if you do forward market hedging, then the cost is 70 lakh 30,000. So which is least? Which one is least among all? So the least among all is forward market hedging. So he should go for forward market hedging. That is the ideal strategy. Clear? Hmm. So after that, see the next question. See the question number 12, case study. So there's a, let me click the screenshot. So, so here in this question, there's a company called Global Limited. It is an Indian company that need $5 lakh, that need $5 lakh in 90 days. So following information is available. The spot rate is this much, 90 days forward rate is this much, and then borrowing lending rate is there. So you have to do the calculation as per the two decimal. So first I'll talk about money market hedging. So money market hedging, if I talk about, so in money market hedging, the two situations happens whenever you do money market hedging, a payable situation and receivable situation. Normally in exam, they always ask payable only. So he need to pay how much? $5 lakh. Okay, so he need to pay $5 lakh. So how much? So the global limited will need, they need to pay $5 lakh. So the amount or amount, many people do get confused with the term amount. Better write the word principal, which the global limited, principal which the global limited, uh, principal with the global limited need to be invested in USA, need to be invested in USA, so that it become, because they need to pay $5 lakh, so that become $5 lakh. How many days? In 90 days. Okay, so how much the money they need to invest? So you know that what is the deposit rate in USA for 90 days? That is 1.25%. So they need $5 lakh. So they need $5 lakh. So how much they should invest so that that money will grow? I hope the other way let me write, otherwise you get confused. Suppose the money what they will, principal is X, so then rate of interest is, if they'll invest in USA, so the rate of in interest in USA is 1.25% for deposit. So that should become $5 lakh. That should become $5 lakh. So that should become $5 lakh. That should become $5 lakh. So how much X dollar they need to invest in USA? So this is X1 plus this is what, 1%, 1.0125. That become 5 lakh. So how much they need to invest? That is 5 lakh divided by 5 lakh. 5, 1, 2, 3, 4, 5 divide by 1.0125. That is 49. That is 4,93,827. 4,93,827. 827.16. So this much dollar, the global limited. So the global limited, how much money they should invest in USA for 3 months so that it becomes $5 lakh in 90 days. That amount is 4,93,827.16. Okay, so they need to invest this much. If they'll invest 4,93,827.16 in USA for 90 days, it will become $5 lakh. And once it becomes $5 lakh, they can pay the money. That is the agenda. But this is an Indian company. How they will get 4,93,827.16? They will get this much dollar. How they will get this much dollar? Because it's an Indian company, so they will borrow money in India, and that they will convert that Indian rupee into US dollar, and then they will invest in USA to get 1.25%, so that it become $5 lakh after 90 days. Okay, so the amount what they need to borrow in India. So you can see the current spot rate. So you can see the current spot rate of dollar and rupees. You can see. So the current spot rate is 69.5. So the current spot rate is 69.5. So the current spot rate is 69.5 rupees. Okay, so the money to be borrowed, which need to be borrowed in India, need to be borrowed in India. The money which need to be borrowed in India is 4,93,827.16 into so you know that this much dollar they need to borrow, so that in rupees how much this will become into 69.5 into 69.5, that is 3 crore 43 lakh 20,927, 3 crore 43 lakh. So this is 3 crore 43 lakh 20,000 20,987.65. So you got this much money they need to borrow in India. Now in India, if you see the borrowing rate, India if you borrow money, what is the borrowing rate? 3%. So what is the amount they need to pay back to the Indian bank? So the amount which they need to pay back, the amount they need to pay back to Indian bank after 3 months, that is the cost after 3 months, that is 3 crore 43 lakh 20,987.65. Rate of interest in India is 3%, no, for 90 days. That is 3%. So into 1.03 into 1.03. 3 crore 53 lakh 3 crore 3 lakh 3 crore 53 lakh 50,000 617.28. Okay. So the amount what they need to pay back to the Indian bank after 3 months, this would be the amount. 3 crore 53 lakh 50,617.28. Okay, now I'll talk about forward hedging. So now if I talk about forward hedging, if I talk about forward hedging, if I talk about forward hedging. So if I try to talk about forward hedging, so 3 month forward rate, 3 month forward rate is 71.5 rupees. So forward hedging, so $1 71.5 rupees. Forward hedging, $1 is equal to 71.5 rupees. Okay, so total commitment is how much? Total commitment is how much? 5 lakh, no? 5 lakh dollar. Total commitment is 5 lakh dollar. Okay, so the amount need to be paid for forward market hedging, for forward market hedging, that will be 71.5 into 5 lakh. That is 3 crore 57 lakh 50,000. This is 3 crore. This is 3 crore 57 lakh 50,000. So now if you compare, this is forward market hedging cost. This is money market hedging cost. So you can see them, which is lesser, money market hedging is lesser. And so you can see that. So since since the cost of money market hedging, since the cost of money market hedging is less than forward market hedging. So money market hedging is ideal in this situation. So so money market hedging is ideal in this. So I hope you understood this. Okay, so if you have understood this, if you like the session, please don't forget to click on the like button. And if you are not subscribed to my channel till now, make sure that you subscribe to my channel. So guys, I hope you enjoyed this session. So I made around 3 videos. So it was altogether 3 videos. So it was altogether 3 videos, and in these 3 videos, we have discussed question paper, international financial management, which came for September October 2020. I believe you have learned a lot from these three sessions, where primarily we only discussed the numericals, which are important for exam point of view. So, so then it's time to wind up the class. Let me just recap to see everything that I've done all problem or not. Yeah, I have done all the problem this for the exam which happened on September October 2020 for international financial management. I hope you enjoyed this class. So don't forget to click on the like button. So thank you everyone. God bless you. See you again for the next class. Bye.